to share with you one of the top money tips from this week, and it's about understanding negative gearing. I've been going through this with a number of clients, and one of the biggest misconceptions is the minute that you actually stop losing money on a property, you lose the tax benefit of claiming the interest and the expenses. And I'm here just to, I guess, run you through the realities of that. In very, very simple terms, whenever you borrow money to build an investment that's going to produce you an income, you're able to potentially then claim any interest expenses relating to any borrowings that you've actually put in place. Now, the important thing to understand is any income that you receive, so it might be rent, it could be dividends, it could be interest, it could be any number of things depending upon what your investment actually is. But the important thing to understand is when that rental income comes in, it gets added on top of any employment income, any self-employed income that you may already have occurred. So you end up from the tax officer's point of view with a total gross income, which is typically going to be higher because you've got new income being added in than just your normal day-to-day employment. However, where the generosity of negative gearing kicks in, or what's termed as negative gearing kicks in, is against that bigger gross income, you're able to actually claim back deductions. So you're able to claim back, if it's a rental property, the interest expense. Also perhaps you've got strata, council rates, water, and a number of other things. No doubt you're paying estate agent fees. You're able to actually deduct that off that gross amount. And for most people, and when a property is negatively geared, effectively what that means is all of those other expenses that you've incurred is greater than the income that you've actually received. So all of your expenses taking away from your total gross income means you end up being taxed on a much lower assessable income. So if your total expenses, for instance, are $10,000 a year more than the rent that you're collecting, it means on your employment income, you're going to pay tax on $10,000 less. So it doesn't mean you're getting $10,000 less in tax. You're essentially getting a situation where you're paying tax on $10,000 less. So depending upon what your marginal tax rate is, whether you're earning $30,000, $50,000, $100,000 or more, that's going to determine how big a break you're actually really going to be getting from the tax man. It's a complicated area. I'm going to be putting together some more information on this, but I just thought I'd just highlight the point that being able to claim a deduction for interest and expenses isn't just when you're losing money on a property or on an investment. You're still able to claim those expenses. So it's just important to understand that in complete context, because that's definitely one of the myths that I've busted for a few clients this week.